74% of retirees failed a basic retirement income test recently. This video will cover off their one big miss and a few others as well. Coming up next on Holy Schmidt.
Holy Schmidt!
According to the American College's Retirement Literacy Income Study, 74% of the people who took the test, that's 1,500 people, failed basic retirement income knowledge. The American College surveyed 1,500 people between the ages of 60 and 75 with over $100,000 of assets, and this group couldn't demonstrate a basic understanding of retirement income and how it worked. This isn't a fringe study, it's a wake-up call. And the number one rule they misunderstood, retirement income isn't about growth anymore, it's about sustainability. Stick around to the end because I'm going to show you exactly what that means and more importantly, what to do about it. All right, let's get into it. I've talked to a lot of people recently about retirement income and the fear is real. They fear running out of money. They fear that they don't understand how everything fits together, and they fear that maybe they might be the one that's calling their son or daughter for help at the worst possible time. So the fear is real. They fear a market crash. They fear a medical condition that wipes out decades of savings. These fears aren't irrational. In fact, they're very rational, and they're interconnected. When you look at what the American College actually found, you start to realize why these fears are so hard to manage. Many people, in fact, most people, are missing basic knowledge in 5 key areas. And when you're missing knowledge, people start to fill in the gaps with things that they think of on their own. And that doesn't help at all. In fact, it makes the problem far, far worse. The first is that they don't understand what sustainable withdrawal rates are. They've heard about the 4% rule, but they don't know if that is a steadfast rule, if it applies to them, if it's a historic rule, and if they should use that rule in the future or not. The second is a basic understanding of Social Security. A lot of them didn't know that Social Security was lifetime income, or that it was inflation adjusted, or that it protects a survivor. They also didn't understand the difference between claiming Social Security at age 62, 67, or age 70. In fact, their claiming decision was often based on what somebody else was doing, not what was right for their specific situation. The third is inflation. Now, most people understand that inflation exists, but even at 3%, they don't understand that your purchasing power gets cut in half in just 24 years. That's not a worst-case scenario, that's an average. The fourth is a basic understanding of Medicare. Most people who are not on Medicare assume that Medicare covers everything, but it doesn't. There are deductibles, there are co-pays, there are maximum out-of-pockets that need to be considered. And it doesn't cover dental, it doesn't cover hearing, and it doesn't cover long-term care, at least traditional Medicare. Some Medicare Advantage plans cover part of that, but the big one that most people miss is long-term care. The fifth is longevity risk. Now, this is a technical term for running out of money before you run out of time. And it is a real risk for a lot of people because they don't connect the fact that that portfolio that we talked about needs to cover 30, sometimes 40 years for many people. Also, the longer you live, the more likely you're going to have major medical expenses. In fact, retirement spending often is described as a U-shape. People spend a lot when they first retire on things like trips, then it settles down during mid-retirement, and then at late-stage retirement, it gaps out again on medical costs and medical-related costs. Having guaranteed income for life, whether it's Social Security, a pension, or an annuity, dramatically reduces longevity risk because it's with you, by definition, for life. When 74% of near retirees fail a basic literacy test, it's not that they're uninformed. In fact, a lot of these people are quite smart. It's just that they've never been taught how all of the pieces fit together. Now, before we go any further, if you want to run the numbers on your own financial situation, check out Bolden Personal Financial Planning Software. Bolden is one of only 3 affiliates that we have on the channel, and it is the personal financial planning software that I use. Bolden just launched an AI planning assistant, and it works inside your plan, your assets, your income, your liabilities, your Social Security, and a whole lot more. And by the way, we're not talking about a generic chatbot. It's AI linked to real financial numbers and, frankly, your information. So if you want to give it a try, go to go.bolden.com/Schmidt and you can try it free for 2 weeks. After that, it's just $12 a month paid annually. All right, back to the number one rule, the one that 74% of near retirees don't fully understand. That rule is that your income must be designed to last as long as you do. This may be simple, it may be obvious, but let me tell you why it's harder than it sounds and why so many people got it wrong. For many retirees, the go-to framework for withdrawing funds from your account was the 4% rule. It's a pretty simple rule, and that is year one, you withdraw 4%, and then from that point forward, you can continue to draw 4% plus inflation, and that amount should last you for 30 years. It came out in something called the Trinity Study in 1998, and it assumed a mix of equity and fixed income products, and for its time, it was really useful. But here's where it breaks down in the real world. The Trinity Study assumes a 30-year retirement. Today, people are retiring at 60, 61, 62, maybe even in their late 50s, and oftentimes it's longer than 30 years. Also, it was based on historical market returns of the time, which were exceptional, and we're starting to see some really good returns now, but they're less consistent. The next point is something called sequencing risk, and this is the one that catches many people off guard. You can take two people with the same expected return of their portfolio, the same duration, 30 years, 40 years, whatever the number is, and one will be successful and the other won't, simply because they retired at the wrong time and the market went down instead of up when they started withdrawing funds for the first few years. This is why most planners don't anchor rigidly to the 4% rule. Some use a range of 3 to 5% depending on what's happening in the world today. Your age, your risk tolerance, what's happening in the markets, your ability to source consistent, predictable income like Social Security, that all matters when you're making the decision about how much to withdraw. And here's the real mistake, and this is the one arguably that matters the most. People still treat retirement like they're in the accumulation phase. So they've got their portfolio, which is struggling to grow, and their need for assets from that portfolio. And so this changes their quality of life, usually in the wrong direction. During your working years, the goal is clear. Invest as much as you can, put it in equities, take some risks, and let it continue to grow. You may have 2 or 3 or 4 or even 5 market downturns while you're working, but in the end, the odds are extremely good that you're going to come out way ahead if you invest primarily in equities. By the way, on that last point, equities in a diversified portfolio like an index fund, to be specific. I'm not talking about making individual bets, although some people are very successful at that as well, but that's a bet. It's not investing, in many cases anyway. In retirement, the objective flips completely. It's not to continue to grow. It's not to take those kind of risks. It's to manage your income and make sure that your income lasts as long as you do. If you withdraw too aggressively, you risk damaging your portfolio. And if you do that at a time when markets are going down, sequencing risk kicks in and you are more likely to run out of money before you run out of time. But on the flip side, if you're too conservative, you've spent 40 years in many cases building a wonderful portfolio only to use a fraction of it because you're worried about running out of money. And of the two, the second is a better outcome for a lot of people, but it's certainly not a way to live retirement if you can avoid it. You did everything right, but you're scared to spend. So the rule, if you're going to use a rule, isn't a rigid number. It's balance. It's getting the balance right. Now, at this point, many of you are saying, thanks, Jeff, that's clear as mud. What do I do? Well, let me give you a good framework to start with. This isn't the total answer, but it will get you much closer to your specific situation. Step one is to lock in your own guaranteed income first. Now, I'm talking specifically about Social Security and pensions, but we'll talk about annuities in just a minute. Social Security is one of the easiest ways to manage your floor because you can wait. Maybe you can wait. It depends on your specific situation, I suppose. But if you can wait, your number gets larger. Now, a lot of people say, Jeff, I hear you, but I've done the math myself, and my break even is at, and you insert the age, 66 years and 3 months, 68 years and 8 months. It's different for different people because of their own specific medical situations, their family history, and their own needs. However, longer is usually better than shorter if you're trying to manage longevity risk. The same thing with pensions. Some pensions will allow you to delay taking the pension and the number continues to grow. And the same thing with annuities. So the bottom line here is that managing your lifetime income sources is really important. The next point is understand your specific sustainable withdrawal rate. Don't just default to 4% because that might not be right for you. If you have more income from sustainable sources like Social Security, pensions, annuities, we just talked about those, or others, rental income, who knows, then your withdrawal rate might be different than 4%. On the other hand, if that's all that you have, well then your withdrawal rate becomes the single most important thing to focus in on, along with safety. The good news is that virtually everybody has some form of Social Security, so you have a base to work with. What you do with that base is entirely up to you. But here's some things to think about with this point. How long do you plan on being in retirement? What is the size of your portfolio? Where is it invested? What is your risk tolerance? Is your risk capability the same as your risk tolerance? Because they're not always the same thing. I hear a lot of people say, well, I'm willing to take big risk. And that may be true, but at 78 years old, if your portfolio dropped by 30%, you may feel okay with it. But would you be good with it? Would you be able to live with that? You get the point. By the way, a fee-only financial planner who acts as your fiduciary or a tool like Bolden will help you immensely with this particular point. As I said, I use Bolden, and I'm on that software sometimes weekly, sometimes monthly, depending on what's going on, but I'm on enough so that I know what my probability of success rate is. Step 3, adjust your spending dynamically. Now, this will help you a lot. In a down market, don't default to 4% or whatever your number is if you can help it. Default to less. And maybe you can flex up a little bit in a really good market. But the fact is, just understanding where you're sitting in the ecosystem of markets is really important. By the way, this dynamic approach has been shown to improve income outcomes dramatically compared to a rigid approach. Step 4, plan explicitly for healthcare and inflation. They're going to be there. Unfortunately, most people don't fully realize this, but I'd plan on, say, 3%. The historical average for the last 30 years has been 2.6%. A few years it's been a lot more than that. A few years it's been a lot less than that. But 2.6% is the actual number. So if you plan on 3%, you'll be good. As far as healthcare, there are a lot of ways to manage future healthcare. A health savings account is a great way to do it, but there are other ways as well. Just understand that healthcare costs probably will be coming. Along those same lines, have a good idea of how you're going to pay for Medicare. Medicare isn't free. It's really inexpensive compared to, say, COBRA or other options if you're paying for your healthcare alone, at least in most cases. But you will have to pay for Part B. You'll have to pay for a Medicare supplement, a Medigap plan, a drug plan, Part D, and or a Medicare Advantage plan. These are real costs that you need to cover, and so planning for them in advance will be a really good way to manage the sticker shock when they happen. Step 5, review your financial plan at least annually. Now, I mentioned that I was on there last week, and I look at mine weekly, sometimes daily. A lot of that is really for the channel here, but the fact is you should at least examine it once a year. I would recommend once a quarter, but annually is a minimum. And if you have a financial planner, they usually schedule you for an annual meeting, if nothing else. And by the way, why don't you just look at the number and say, you know what, it's up 10%, I'm good, or 5% or 20%, whatever the number is. The reason is because things change. Even if you had a good year, things still change. Tax laws change. For example, this year, tax laws are completely different or dramatically different anyway than they were 12 months ago. Markets can change. A good financial planner can help you get a sense of some of the risks ahead, and you can work together with your planner to understand what you need to pay attention to and what you can forget about. Also, financial planning software like Bolden gives a similar view in a lot of cases. Now, here's what I want to leave you with in this video. The number one retirement income rule isn't the 4% rule. It's not the 5% rule. The only rule that matters is that your income must last as long as you do. Everything else is there to support that outcome. 74% of retirees don't understand how retirement income works. Now you do, and that puts you in a completely different category. If you want to go deeper on Social Security, I have a course called Social Security Simplified. Go to holyschmidt.com/social security, and you can see the landing page for the course. If you decide that you want to purchase the course, use the coupon code 60OFF, and you can get $60 off of the purchase price of the course. It's 24 videos. It comes with a 103-page workbook. It has a 30-day complete, no questions asked money-back guarantee, although, frankly, we rarely have people who ask for their money back, but it is there. We call it the no bullshit guarantee. I know. But the fact is, it takes you from beginner to confident in about 5 hours. If you want to understand your own numbers deeply, check out Bolden. They have their new AI planner assistant. It's excellent. Go to go.bolden.com/Schmidt. Get your 2 weeks free, and after that, it's $12 a month paid annually. Finally, if you like this video, check out that video, The Hidden Risk That Erodes Net Worth After You Retire. This is Jeff Schmidt, and I will see you in that video right there.